Investors are anxious as market volatility continues amid tariff talks and Trump's criticism of Federal Reserve Chairman Jerome Powell. Here to weigh in is NewEdge Wealth Chief Investment Officer Cameron Dawson. Cameron, thanks for joining us today.
Thank you for having me.
So let's start with your view of the overall markets right now. You've described it as purgatory.
Yeah, so we are evoking Dave Matthews Band and calling it the space between. The space between the big tariff announcements that shocked markets back just a few weeks ago and the eventual impact to hard data, real economic data, which we think could take some time. So we think that this volatility in markets continues as we kind of figure out which way the market will break.
So there is some good news here, which is that sentiment is really in the dumps. That often is actually a bullish indicator, right? Everybody who wants to sell has already sold.
Well, certainly what we're looking at things is sentiment measures. Deutsche Bank consolidated positioning has fallen from 96th percentile to start the year all the way down to the 2nd percentile today. We can also see
that means it's better 98% of the time.
Well, meaning that, yes, you don't get much lighter positioning than this.
Wow, okay.
And so that does set up for the potential for a rebound in markets, meaning that you have the ability for sentiment positioning to flip the other way. The problem is you have things like deteriorating trend and momentum, which suggests that maybe those rebounds could be short-lived.
You have the death cross. That does not sound good.
Well, the death cross is something that's not necessarily a timing tool, but what we see is that when the 50-day moving average crosses below the 200-day moving average, it's a sign that that up and to the right trend is no more, meaning that expect more volatility, expect choppier markets, and it does raise the bar for upside to really break into new high territory.
And on top of this, we have this feud between President Trump and Fed Chairman Powell. It's really kind of a one-sided thing, right? Trump has been threatening Powell. I don't know if terminate means he wants to fire him. And we're not even clear that that's possible. But what do you think would happen should Trump actually try to remove Powell or actually succeed?
We do think that Fed independence is paramount. It's very important. And if we lose that Fed independence or there's a big question mark around it, it could result in something like a curve steepener, where the short end of the curve prices in the expectation that the Fed will be cutting rates. The long end of the curve prices in the risk of inflation expectations blowing out and questions about fiscal prudence. So we do think that if you see questions about Fed independence, you will see that curve steepener.
And that's bad because that means mortgage rates go higher even while your savings is giving you less.
We're calling it the zoo steepener. So you get a bull steepener on the short end, a bear steepener on the long end, and that's not a good scenario for the U.S. economy because, to your point, you get less cash interest income and all those record money market balances, but you don't get a boost to the housing market because mortgage rates stay high.
Wow. Okay. So what is your playbook in this scenario for investors?
We think it's really important to not get emotional in times like this, which means that when we see big spikes in volatility, when we see markets get washed out, if you have cash on the sidelines, it's a great opportunity to take advantage. However, we think that investors have to be really disciplined in finding those opportunities within markets. We're focused on quality stocks. That's really our mantra, is looking at quality stocks that have good free cash flow, strong return on invested capital, but also valuation discipline. Valuations, we think, still could come under pressure, so not buying too expensive stocks remains important.
So the first two descriptions of quality stocks sounds like the Mag 7. The second one, we're getting closer as those valuations come down. Is that a safe place to hide? I mean, they got very strong balance sheets, those big tech stocks.
These are fantastic companies with really strong return on invested capital, as I just said. The challenge you have is those stocks are very crowded and they are seeing decelerating earnings growth. And that oftentimes is a challenge for equity market returns. When earnings growth goes from really high levels to slower levels, you typically see forward returns start to level out. So we think that Mag 7 just has a lot less room to outperform in this environment.
And you've talked about, for instance, Meta and Google. They have pretty vulnerable earnings right now.
Well, they are advertising-based companies. So we think that these Mag 7 companies are hyper-defensive. The reality is they still are very sensitive to the economic cycle. Take a name like Meta, that is 98% advertising. So if we were to go into a weaker economic environment, it would likely be that advertisers would pull back on spending. End result being is that they're not immune and that we all do breathe the same economic air.
All righty. Well, we'll have you back when we're out of purgatory and we go to heaven or hell and figure out what that's all about.
Oh, goodness. Thank you.
Thanks a lot, Cameron.